Investing is the most effective way you can build your wealth and save for long-term goals like retirement, or paying for college, or buying a house. The sooner you begin investing, the sooner you can take advantage of compounding gains, allowing the money you put into your account to grow more rapidly over time. Investing is an extensive topic, and that is why we divide the topics over several videos. This is the first video about using investment funds to reduce risk. Don't forget to check out our other videos as well. See the link at the end of this video, and please subscribe so you don't miss any updates. Risk tolerance is one of the first things you should consider when you start investing. When markets decline as they did in 2022, many investors flee. But long-term investors often see such downturns as a chance to buy stocks at a discounted price. Investors who can weather such downturns may enjoy the market's average annual return, about 10% historically. But you must be able to stay in the market when things get rough. Some people want a quick score in the stock market without experiencing any downside, but the market just doesn't work like that. You must endure down periods to enjoy the gains. To reduce your risk as a long-term investor, it all comes down to diversification. You can be more aggressive in your allocation to stocks when you're young and your withdrawal date is distant. As you inch closer to retirement or the date you're looking to withdraw from your accounts, start scaling back your risk. Your diversification should grow more conservative over time so you don't risk major losses in a market downturn. Investors can get a diversified portfolio quickly and easily with an index fund. Instead of trying to actively pick stocks, an index fund passively owns all the stocks in an index. By owning a wide swath of companies, investors avoid the risk of investing in one or two individual stocks, though they won't eliminate all the risk that comes from stock investing. Another common passive fund type that can reduce your risk aversion and make your investment journey easier is a target date fund. These set-it-and-forget-it funds automatically adjust your assets to a more conservative mix as you approach retirement. Typically, they move from a higher concentration in stocks to a more bond-focused portfolio as you approach your date. Want to know more? View this video about our next topic: understanding your investment options.